what do you think? I mean, on one hand, at least, well, I don't know. The markets on one hand seem to always be crying about growth concerns, and Ashu's putting a very different spin on it, and very valid as well in terms of those rate hike, worries as well that are equally important. How are you, interpreting this data?
Well, good morning, and thanks for inviting me on the show. I mean, it's fascinating in itself, and when you look at the complexities as far as Japan and what they're trying to achieve, and of course, one puts its minds back to, a Nikkei that hit 39,000 points in '89, crashed to about 8,000 or 9,000. The only way out really is inflation, and that's why their whole mantra has been that. So it doesn't surprise me, but I think I'm going to be a very old man before the Nikkei gets to 39,000 and inflation hits 2% in Japan. So I hope it happens for them one day, but I think that will be one of the only key drivers they've got to try and get some form of stimulus and get some spending power and get the economy moving.
Good morning, Peter. Of course, the Bank of Japan also is like a de facto sovereign fund sitting with, I don't know, I think 9% of all the stocks on the Japanese stock exchanges. Let me ask you, I mean, every time they stimulate the economy, I guess they'll have to sell some of this stuff. So what does it do to the market? I mean, they're sitting with loads of this stuff.
Yes, but I suppose the other side, of course, is that they've got, large inflows. I don't necessarily think that they'll have to sell stock, because they seem to be buyers of stock and not sellers to try and support it. I think I look at the Japanese economy and I'm very worried, quite simply because of the ageing population. It's a robust nation in itself, but I think its glory days are well and truly behind it. What I've experienced, of course, with the economic miracle, similar to what Germany experienced in the 60s and 70s and 80s. It just seems like Japan, it'll take a long time till we get back to those sort of numbers. And I feel as though any form of, government intervention or buying or trying to stimulate, it's going to be a very hard road to hoe.
Right. Peter, it's not just Japan. I mean, even the big question mark as to how much, China can also continue to see stimulus measures. Is it the impact really of stimulus that we're seeing right now? Is it sustainable? Some of these questions continue to do the rounds as well. What's your take on China right now?
Well, I mean, Larry Fink says, and I just saw something on your site, but certainly, if you're controlling the sort of money that Fink does, then it gives you some sort of indicative number that there's a lot of problems ahead, huge debt levels, overhangs, and so on. And I think that the way China's looking, it's going to be a tough, hard grind out. The next, probably the next 18 months to 3 years are going to be crucial for it. And what happens, I think that if it does come unstuck, it's certainly going to drag a lot of the markets down. There's a lot of bears out there that are saying prices are overpriced. Stock prices are overpriced across US and so on. So how it plays out, I think, is going to be very intriguing.
Peter, I'll just share some data with you. And what I needed to check with you is if you think that the markets shift in asset classes has already happened. US data shows that $44 billion went out of global stock funds in the last 5 weeks. $7.4 billion in just 1 week alone. $2.3 billion from emerging markets in 1 week alone. And where's the money going? It looks like it's going to commodities and bonds. Most of this money seems to have gone, if you look at the year-to-date data, it's $90 billion out of global stock funds. It seems to have gone to oil, gold, Brazil, Russia, and Canada. Not your usual suspects, Peter. Do you think the market started to look at another asset class altogether?
Well, when you look at what the rebound's been as far as crude, over that last, say, 3 months, we're up about 75, 78%. It's been amazing. It's been a very, very bullish run. I think you've got the big boys now. You've got Soros and co. joining. They're worried about Brexit. They're worried about what's happening globally. They're entering the gold market in huge numbers. You've got Paulson sitting on the sidelines. And, of course, you take all that into consideration. Markets do become exhausted to the upside. And you're probably thinking, well, those equity markets have had very strong run-ups for a long, long time, and the other markets were oversold, and that was demonstrated with crude. It's lifting all boats. Goldman's are even saying you're going to see, $50 plus oil in the second part of 16. Though it's not that bullish a forecast, considering we're now at about 48 or 49. And then you're looking at emerging economies and strong economies. You look at India, for example. The top 4 consumers in the world in this order, of course, are USA, China, Japan, and India. And India is going to overtake Japan as the 3rd largest consumer of crude oil and energy in the next 12 to 18 months.
Yeah. So, Peter, so my question now relates to the minutes of the FOMC meeting the last time they met. Unusual to them, they just made a long-term projections. We expect interest rates to remain, something to the effect low for a long time, whatever. But it now seems that we're actually heading probably into a higher interest rate regime if oil prices continue to rise like this. So can we say goodbye to lower interest rates and perhaps interest rate hikes coming in maybe from the Bank of Japan, maybe from the Federal Reserve? What does that do to the dollar, and what does that do to emerging market currencies then?
Well, that's a good point. I mean, I want to get through the next probably 6 weeks and see what happens as far as the Brexit issue. You've still got weakness across the Eurozone. It's all right for Japan to say, well, we want that 2% headline number. Maybe you're going to see you've got a lot of large positions across oil as far as short positions, and that seems to be gaining momentum. So a lot of traders are saying that that's becoming now a bit exhausted and you're going to see a pullback. And then what happens as far as emerging markets and the dollar, if they put rates up and Yellen's mob put the rates up, then obviously you're going to see, I think, probably a bit more of a strengthening of the US dollar because of just the sheer weight of numbers and people pulling out of existing markets. So I feel as though that the US dollar could have a little bit further of a rally. And then what happens to emerging markets, well, that's going to play into itself as far as energy costs and what happens moving forward. So it's a delicate situation. I think volatility is going to be very, very rocky over the next 6 months leading up to, Christmas.
So, Peter, given that there has been significant exuberance on emerging market stocks in the last 5 to 6 months, is it time to reallocate your money out of emerging market stocks into maybe bonds or maybe precious metals like gold and silver or something that has physical value?
Well, it's not uncommon for wise investors, and certainly the retail sector is across it when you look at, the different instruments that you can trade in. And a lot of people are probably saying that, markets can wash out very, very viciously and take your profits and sometimes sit on the sides. They may look at bonds and they may also say, well, look, do I trade currencies or, what market is offering the best return? But at the present time, I think many traders are saying the US stock market is probably a little bit toppy. They're not looking for huge headline numbers to be strong over the next couple of months, and they'll probably sit on the sidelines. And then you look at precious metals and what's happening there, and I think that there's going to be more momentum. So that's because of the uncertainty. So I wouldn't be surprised to see more people enter that space, which in turn is going to probably push it higher.
Right. So one last question, Peter, and this is on a lighter side. This Mark Cuban, I think he's a billionaire, and I think he comes on one of those Shark Tanks or something. He says, well, if Mr. Trump decides to become the president, it's a real problem for the stock markets. He is sure it's going to drop maybe, 50% or whatever. What do you make out of this? I mean, it looks like this man is going to become the president. And what does it do to global markets if this is the way it's going to go?
Well, look, from where it's sitting at the moment, there's a very big chance, and I agree with you, that he may end up in the White House. What happens to the markets, that's a great unknown. Whether they're going to embrace him and they're going to say, well, yes, we've got our saviour here and he's going to save the day, or we've got turmoil. And there's a mixed camp in that regard as well. So I think that just adds more complexity and of course, volatility over the coming months, and it gets closer to the point. So I think that volatility with Brexit and the situation there, then leading in from a geopolitical side, the instability as far as the Middle East, and what's going on with energy prices globally, and then leading into the Trump versus Clinton dilemma, you can see why there's going to be, we think, an increase in vol over the coming, 6 to 12 months.
All right, Peter, interesting times there. Thanks so much for joining us this morning. We'll, of course, keep chatting with you.